All right, let's get started. Good afternoon, welcome. It's great that you're able to attend. This is the Personal CFO's Expert Speaker Series. I'm Daniel Collison, Managing Partner with Advice to Advisors, and along with my business partner and Marketing Director of Advice to Advisors, it's great to have you here this afternoon. For those that aren't familiar with us, Advice to Advisors is a training, coaching, and speaking business where we work only with financial advisors. That's our website if you need to look at what we do in any extent. But our job is to help advisors build businesses in the format of a personal CFO model and to actually go to market with technical knowledge that they can prospect and market themselves to, and then support themselves with the experts that they need to help them take care of their clients. I'm going to get through our little part very quickly. So just to give you some background on the personal CFO model, a few years ago, Moshe Milevsky, a finance professor out of Schulich School of Business where I teach, wrote a book, Are You a Stock or a Bond? And in that book, he posited the idea that individuals and their families should really treat themselves like businesses when it comes to dealing with their personal finances. You know, businesses are very effective, they're very efficient. And really what Moshe said, you should act like a small, tightly controlled, privately held company, you know, and work effectively through that. And what he said then was that, you know, you've got to be the CEO, the CFO, the chairman of the board. You've got to maximize your shareholder value for You Inc., as he named it, You Incorporated. This is the job that every family really needs to take care of. But here's the big problem. Most people don't have the time, they don't have the expertise, they don't even have the inclination to deal with their own personal finances. And as all of you are well aware, there's just way too many complexities for them to take care of their own finances. There certainly are the do-it-yourselfers, but they tend to be just more so in the marketplace, and they don't deal in all aspects of financial planning. Our belief at Advice to Advisors is that the best financial advisors, the really top performing one, and this comes from us talking to top producing advisors throughout North and South America, as well as doing a lot of reading of research that proves that the best advisors take on a model like this, where they do treat their clients as CEOs, or if it's a couple as co-CEOs, and then they take on that mantle of personal CFO to their clients under the You Inc. auspices. And then they set themselves up with the experts that they need to support them and to support their clients with all of the expert knowledge that's required within these 5 primary expert categories. They act as the conduit to those experts when they're building out financial plans. And the reason we look to these experts, as you can see, there's just no doubt that there is far too much information, too much knowledge, too much wisdom that you can't take on yourself. So as that personal CFO, you absolutely have to be tied into the professionals, the experts that are going to help you take care of your clients. You know, there was a great quote that I heard from an advisor in Ottawa many years ago. He said, if it's got a dollar sign in front of it, give me a call, which means don't let anything pass you by. If you're going to take care of your clients and you want to build a wall around their financial wallet from a competitive point of view, the personal CFO model is the route to go. And you've got to surround yourself with the experts that are going to help you take care of your clients. So let's get really right into it right now. We've got, thankfully, Elena Hansen of Hansen Cross-Border Tax Inc. to talk to you today about the top 10 critical Canada-US cross-border tax issues with Canadians and US assets and families. So I'm going to turn it over to Elena right now, and take it away, Elena.
Thank you, Dan, for the introduction, and thank you, audience, for joining in this discussion. As Dan mentioned, my intention today is to walk you through most commonly raised issues which are brought by both taxpayers and advisors such as yourself when they run into Canadians who have either income coming from the States or Canadians with assets held in the States or in Canada, US assets, or they may be married to US citizen. So I would like to have the discussion today as informal as possible, and should not be considered as tax advice. If you do have a situation where you require expert opinion, then feel free to give us a call and we would be happy to help you or your clients. But so let's just jump in. And here's the list of those 10 topics. I have a full deck of slides, but I decided not to flip through them because it's time, we were time constrained today, but also certain of those topics, they're very difficult to segregate. They kind of need to be discussed in conjunction, in reference to the others. So if you want to have a deck of slides, feel free to contact Dan or Tina, and they will give you them for reference material. So when we deal with taxpayers, we first need to identify who they are, because if you're gonna start advising something and later figure out, well, the taxpayer is actually a U.S. citizen, even though first you assume that the person is not a U.S. person, then your advice just needs to be scrapped and you need to start from scratch. So the first thing to do is to figure out who's in front of you. US law is, it's both a bright line test and also, factual. So, a US person can be either US citizen by birth, naturalization, birth of their parents, or green card holder, or person who's Canadian, but happens to spend significant number of days in the States, whether on an annual basis or on 3 consecutive years. And when you count in those days, it's not just a full 24-hour presence in the States. A fraction of a day is considered a full day. So if you have someone who lives on the border and shops across the border, for food, I mean, we cannot do it now during the COVID period, but in a regular life, then that shopping, those hours, picking up the cart of milk is actually considered a full US presence day. Okay, so after we've done our decision tree, figuring out that the person is in fact not a US person, then we can do an effective planning with respect to other items listed on this page. And so I guess, the most common question we get with respect to Canadians is US real estate or US gifting, or real estate gifting, or US estate tax. I mean, there's no surprise that this is a very, very topical topic, has a lot of interest because, I mean, we live in a cold country. Many of us either, considering purchasing something down south already have, and again, this is maybe your recreational property or your rental property, or the combination of the both, or maybe you want to leave it as a legacy to your family. That's why I would like to discuss all the second, third, and fourth items kind of in aggregate. So when people are buying US real estate, I mean, obviously they first want to know what would be the best structure to hold that real estate. And, again, there is no simple answer to that. I would say you kind of choose the better of the worst. So, and there is a number of factors you need to consider before jumping in if you haven't purchased the property yet. And those factors would be the value of the property, your personal net worth, your age and health, you are in, how long you're planning to hold the property, what the property is going to be used for, again, personal, rental, combination, then, okay, what about the creditors proofing? Are you willing to file tax returns on an annual basis? Do you have a competent accountant who will be able to do it properly? And so you're not double taxed on an annual basis or on the disposition. What is going to happen when you pass? What about probate? What about disposition after your death? So there's a lot of questions on the table. And you know, depending what the answers we're hearing, we may suggest you know, certain options, so the options we typically work with US LLC, cross-border trust, Canadian corporation, partnership, or holding the property outright. And if you hold the property outright, it's either sole ownership or joint tenancy with the right of survivorship, or tenancy in common. So tenancy in common it's when there is a definitive percentage of ownership by co-owners. Okay, so versus a joint tenancy with the right of survivorship, it's both, like if it's a husband and wife, because that's where it's, you see that most, both of them have 100% ownership in the property. So yeah, you know, out of all these options, the option which we never advise is the LLC, because it has a total different tax treatments under US and Canadian laws, and it can just, you know, in aggregate, after paying all the taxes, you can be keeping only $17 out of 100 you earned, you know, if it's a rental property. So paying 83% tax is not fun. It's not a good business strategy. You know, LLC falls off. We're not even considering that. Everything else, again, could be feasible, could be optional, depending what we're hearing from you. You know, obviously holding the property personally is the simplest way, because the treatments, the income recognition is more or less aligned between two countries. You're eligible for foreign tax credit if you end up paying taxes in the States at the federal and state levels. Also, it's the least reporting you have to do. What you need to be aware, however, that if you hold the property outright, there will be probate, okay? And probate in the States can be quite lengthy and expensive. If we're talking about Florida, it's typically somewhere between 3 and 5%. Takes from 12 to 24 months. And during that period, your property is frozen. You cannot refinance it, you cannot sell it. That's on the probate side. There's also US estate tax. And from the US estate tax perspective, the way the US government works, you know, I would say the process takes between 2 and 5 years. So be ready to go through, you know, that motion if you decided to hold it personally. So with respect to US estate tax, again, we get phone calls and they say, hey, you know, I am worth less than this and that. I'm not subject to US estate tax. Well, okay, so if you hold US assets, okay, I have a slide what constitutes US citus assets for estate purposes, but you know, most common would be US real estate or US securities or debt, hold with your broker, whether in a brokerage account, non-registered or registered, your RSP, your TFSA. So if the market value of those assets on the day of your death is more than 60,000 US, 60,000, very, very small amount, you are subject to US estate tax, okay? So your executors, your loved ones, whoever picks up the file, will have to go and do reporting with the US government to clear the title to those properties at the IRS's level. And now you may not owe, they may not cutting a check to the IRS, but they still have to report. And they will have to go get a clearance certificate that their executor's obligations with your U.S. estate obligations have been met. So the actual U.S. estate tax rise, if and I'm using the 2020 rates, if your worldwide estate on the day of your death, worldwide, Canada included, any other countries, is more than 11.58 million US. Okay, so huge amount, the largest ever in history. And if your assets are going to a surviving spouse, then you can claim a marital credit, and that 11.58 million can double. Okay, so in other words, if we have a very wealthy people who are worth more than 23 million US, or actually under 23 million US, they can completely avoid the US estate tax. But again, this is not something available automatic. The executors must file a return and claim the treaty benefits under Article 29B in order to be eligible to avoid cutting a check to the IRS. Okay, so that's with respect to U.S. estate tax, which is considered a wealth transfer tax in the U.S. And so is the gift tax. So gift tax is another wealth transfer tax. And you may ask me, if I am making a gift to my kids, let's say gift of US real estate, will I be able to claim that 11.58 million exemption during my lifetime? And my answer would be no, you can't. You can do it if you're an American citizen, but you cannot do it as a Canadian person. So what it means is that if you decide to gift US real estate during your lifetime, as opposed to sell it, you as a donor gonna be subject to US gift tax. And gift tax is imposed on the market value of the property on the day of gift, and is charged at the rate between 18 and 40%. So again, can be quite pricey. If you buy a property today at $300,000 and decide that you really don't need it and you want to gift it to your child, you now will have to pay tax on that $300,000. And what is happening is that your child is gonna acquire the property at your original cost basis, okay? So even though you're paying tax on the market value, the acquisition will be at original cost. The child can add the taxes paid to adjust the basis, but this is very different from the Canadian treatment. Because if you're making a gift of the US property as a Canadian to a donor, there's gonna be deemed disposition treatment in Canada. And deemed disposition is imposed the capital gain tax on the appreciation on the property, right? So you have a mismatch now, and the recipient gets the property in Canada at the market value. So what is very critical here is that the tax you pay in the States, a gift tax, you cannot credit in Canada. So what ends up happening, you're now double taxed, and you have a mismatch in values of those properties on a forward basis. So when people ask us, is it a good idea? We typically tell them it's a terrible idea. So I cannot be more descriptive about this planning option. All right, moving on to the next block of questions is IRA, 401ks, and US pensions. So, again, we're very mobile. 80% of or maybe more of Canadian, I don't know the latest statistics, but Canadian economy is tied up to US economy. And therefore, it's very common when Canadians go to the States, either on a temporary basis or a somewhat permanent basis to work for a US employer, and they get pension benefits. and then they decide to come back, or they have Canadian beneficiaries who would receive their US pensions. And so there's a lot of decision, to be made. What is the better way for me to handle those benefits? The reality is that the treatment, the taxation, and the recognition is not quite intuitive, and I will explain to you that in a minute. So what's happening is that if you were a US resident and you decide to come back to Canada, most of your assets will get a step up in basis for future capital gain determination or income determination. So you're only going to be subject to taxation in Canada on the growth from that point on. When it comes to your US pensions, you do not get a step up in basis. So we had a case when a lady moved to Canada. There's no proper planning was done. She moved to Canada. She passed within 3 months in Canada, and in the States, there could be deferral done with respect to her pensions, but in Canada, there's no deferral. So all of a sudden, we have this triple taxation. And that was very painful, that was very unfortunate for the beneficiaries. So no step up on any pensions you bring to Canada on becoming a resident or reacquiring your Canadian residency. So what's happening then? You are in Canada now, you have this large pensions or somewhat, semi-large pensions or small pensions, which you just don't want to be too diverse, you want to bring to Canada. So you're thinking, okay, what shall I do? Because what's typically happening is that very often those pensions, they are frozen in the States. So you can retain the holdings, but you cannot, change your portfolio. And also there's a foreign exchange risk. If you retain those US pensions or IRAs, your estate now is exposed to US estate tax. So those drivers very often make you to consider to bring those pensions to Canada and perhaps roll them into RSP. And again, we have various advisors going different direction and providing us pros and cons. So a big pro we see in enrolling into RSP, especially when it comes to IRAs, is that once you retire and you want to do income splitting with your spouse, you cannot do income splitting with IRAs. Okay, so you can do income splitting with 401ks, but not IRAs. If you bring your IRA into your RSP, then obviously RSP is eligible for income splitting. The hesitation, the apprehension taxpayers have with regards to bringing their US pensions and rolling into RSP is that there's going to be immediate tax implications in the States. And that is absolutely true. Depending on your age, US would want to tax you either at 15 or 25% on liquidation of that pension. So what you need to be aware of is that, and that's when I said it's not intuitive, when you want to bring that pension and roll it into your RSP, you want to have sufficient income in Canada to be able to absorb that 15 or 25% tax you end up paying on liquidation. Okay, so you would think the less income I have, the better timing it is to bring the RSP. Well, that's not true. That's the worst timing. Okay, so talk to us, talk to someone like us, and do that modeling. At what time shall you roll into RSP if you're still at the eligible age, and this is a strong consideration you have. Because if you're gonna end up with IRA, then there's, as I said, there's a state tax issues on the US side, but there's also some complexities on the Canadian side. Because the treatment of your IRA will be quite different depending on several prongs, how fast your executors are acting, whether there's a direct beneficiaries to your instrument, and what age you are, whether the IRA is mature or immature. So by mature, I means that the minimum distribution has commenced. So if you started drawing already from IRA, that's a mature IRA. But if you happen to pass before that time, then it's a mature IRA. So when it comes to mature IRA, there's 3 ways to recognize that distribution, depending how fast the executors act, because they may miss deadline, and then unfortunately the tax consequences gonna be pretty onerous. So the income from IRA, the worst case scenario is that when income from IRA will be recognized as a lump sum on your terminal return, and then the treatment is going to be very similar to your RSP on death. The second option would be to recognize the lump sum on rights and things. That's a separate return, which is filed a year after death. The best option is actually the IRA is treated as an inherited IRA, and it goes to a beneficiary, and then the beneficiary can stretch that IRA, okay, over a certain period of time. So they don't have to recognize the lump sum and pay the highest bracket. They can actually, have a bit of a tax break there. I mean, obviously, depending on the tax bracket, if they're in a top bracket, there's not much planning you can do. So although you want to have at least in that over 220 for anterior rates. For mature IRA, there's a 2 ways you treat it. You recognize on the terminal return the portion which was paid out during the lifetime, and then everything else goes to your surviving beneficiary for as long as, again, it's administered within a proper time frame. So with respect to the stretch, again, this is a brand new law, and again, I am not sure how much on top the advisors are. So we had a Secure Act, which has been enacted at the end of 2019 by the Trump administration, which basically scrapped the previous lifetime stretch. That was very generous. I mean, imagine you're a beneficiary of age 5, you have 100 years life expectancy. You can recognize that minimum distribution over the next 95 years. So now we have a lifetime stretch only available to very limited number of beneficiaries, such as wife or infirm person, or minor, until the minor reaches the age of majority. But for majority of the beneficiaries, that is gonna be 10 years. Okay, so as you can see, that extension has been curtailed quite a bit, and therefore, speaking of this, very often what we do pre-death tax planning, right? For instance, if you have a father who resides in Florida and has a large IRA 401k, and we have 2 beneficiaries in Canada, we may suggest, hey, father, recognize more income while you're still alive, because it's still going to be taxed at the more preferential rates, considering Florida doesn't have a state tax, as opposed to what your kid's going to inherit, because then they're going to have only 10-year stretch, and they're already taxed at 54%. Okay, so how are we doing then with time? You unmute. Can you unmute yourself?
5 to 10 minutes.
Okay, plenty of time. Thank you. So the last 4 topics, they're more of a potpourri, so they're kind of from unrelated issues. So the first one, investment in US partnerships and LLCs. Again, us Canadians, we have a TSX, which doesn't give us much diversity there. So therefore, we always looking for other options. And US partnerships are very popular option for taxpayers to invest because they generate periodic income. They also can give you a very very nice benefit on the final disposition. And but very often people jump into investment opportunity without realizing what is going to happen next. And once they find out, they often regret, that they did not do a proper, the homework up front. So what investment into U.S. Partnership entails, from the tax perspective, is that if U.S. partnership is engaged in U.S. trade or business, then you will have U.S. reporting obligations. So be ready to start filing U.S. tax return, even if you have a absolutely de minimis, $10 income. Okay, you have to file a tax return, and when you file that partnership tax return, what's happening is you will have to go on an income by income basis. So by income type, income character, and it's taxed very differently for non-residents. So there's ordinary income and rental income taxed certain way, but then U.S. dividends, different ways, capital gains, interest, third way. So even though income may be reported on U.S. partnership slip, it does not necessarily mean that it's taxed by the U.S. government, okay? So be very careful with that, because what's happening, if you go and tax everything, well, Canada is not gonna give you credit for everything, okay? So now you are double taxed. You voluntarily remitted too much money to the U.S. government. When it comes to LLCs, as I said, LLCs are always a very dangerous entity in the eyes of Canadian investors, because from the U.S. perspective, LLC is a flow through in most of the instances. From the Canadian perspective, because no one has unlimited liability, it's always a corporation. So what will happen is that when you file your U.S. tax return for LLC, you will have to, pay tax based on income allocated to you by the LLC. But when you do a Canadian tax return, you only taxed by Canada on the distribution from the LLC. So those monetary amounts, they may be not matching, okay? So again, you end up being double taxed. There's a timing difference on your income recognition, on your tax payment. And also, it's a complexity. You may have the unnecessary review by the CRA and go into the correspondence with the government. So it's just, again, do your homework. Speak to someone before making an investment, especially if it's a small investment, because it may not be worth it, okay, due to subsequent consequences of reporting and taxation. The next one, kids moving to the US. Again, this is a very popular topic because it's just depending what family the kid is from, and depending what ends up with the kid once a kid goes and gets a degree or partial degree or whatever it is, it may become a complete nightmare for the family. If you go if you become a student in the States, you go, you get your degree, you comply annually, you do certain disclosures as a student, okay? You need to file something in the States, and then come back to Canada, we're fine. But if you go to the States and you like it, and you decide to stay, or the family buys you a house in the States, or you fall in love, then we're potentially facing a very nasty tax implications. So it's basically as if you're dragging your entire Canadian family now to face US tax implications. So talk to the advisor, especially if we have family trusts involved, joint accounts with parents involved, family corporation involved, family partnership, family disregarded entity, all that creates complexity. The next topic is marrying a divorcing U.S. person. So my focus today on Canadians who are not Americans. So but some of us, me included, are married to a U.S. citizen. If you are facing a marital breakdown or separation, then what you need to be aware of that is that the U.S. rules are not aligned to Canadian tax implications. Okay, they've never been aligned on various issues before pertaining to this particular taxable event. But after the Tax Cut and Jobs Act of 2017, the separation is so much wider now. So the key point is that in Canada, when we pay spousal support, payors eligible to deduct, and payee, the recipient, recognizes that income. Well, that was the case in the States before. That's no longer the case now. So in the States now, if you pay alimony to your spouse, that's not deductible. So similar to child support. And as a spouse who recognizes that income, that's not a taxable income. Okay, so all of a sudden we have a mismatch. And what's important is, what country did we have that separation incepted? So like, there's many factors to look into when you do planning, when we do asset allocation, before finalizing that agreement. It's very important to really understand U.S. tax implications, because if you don't, then the result can be very costly and unfair. Okay, and the very final topic of my discussion today is the U.S. tax ID. So anything you do in the first, I would say, eight items on my outline, you need a tax ID because you're likely going to be subject to U.S. reporting. So there's two tax IDs in the States. It's a Social Security number, and it's an ITIN, Individual Taxpayer Identification Number, and they're very different. Social Security is trumps everything, right? So that's the number which allows you to work, which allows you to pay tax, to contribute to your Social Security benefits, to draw your benefits later in life. So that number typically assigned to you for either you're a citizen or green card holder, or you exercise employment in the States. For all other matters, you eligible for ITIN. You need to request an ITIN. The eligibility doesn't come because you just want to have a U.S. taxpayer ID. You will apply because you either have to file a tax return, or you eligible for five of the exceptions which allow you to obtain an the ITIN without filing a tax return. So again, you cannot do it on your own. You need someone, actually you can do it on your own. If you do it on your own, you need to send your Canadian passport to the US government. Bad idea. They can shred it. We have cases like that. So you need to talk to a person who is IRS certified acceptance agent, who can assist you with certifying your passport for the IRS purposes. We're one of them. By submitting certain paperwork with a certified passport, you should get your ITIN, which you can use for IRS reporting purposes, or reporting your income to U.S. states. All right, Dan.
Well, that was
my
lot.
Marathon. Yes, it did felt like a marathon.
That's fabulous. Thank you, Elena. As you folks can see, this is deep, and sometimes it's actually dark. But if you've got clients that have to have that type of expertise, obviously you can talk to Elena. Another thing that I would suggest, however, is also, if you've got contacts with these types of individuals, cross-border individuals, you can use some of these items as prospecting questions to them to start to disturb them and motivate them, disturb them to what they don't know, and then motivate them to talk to you and then to experts such as Elena. So you've got the opportunity not just to service your own clients, but take on new clients by flipping some of these items into actual questions. And if you have any questions right now, just put them into the Dropbox. We've got a couple minutes left. I just want to remind you the whole concept here is for you to take that personal CFO model and work with experts such as Elena to ensure that your clients are taken care of, and then that also you've got the opportunity to grow your business by prospecting with this type of information. So Tina, if you're there, I know
I'm here.
offers. So if there's any questions coming in until we get the questions, I know Advice to Advisors, we do have some offers that for any of you advisors that are looking for some deeper information, deeper study on how you take on the personal model. If you wanted to talk to that, Tina, and unless
Yes, very excited to talk about that today. So these are both virtual programs. Obviously, we're taking advantage of the social distancing and getting all the training out of our system now before we return to our new normal. The first part here is our Prospecting Genius of World-Class Advisors. That's a 5-part video series. Basically what that does is it outlines the 2 levels of confidence that all financial advisors need to master. That's their mental confidence and their business confidence. So we've got 5 sessions there. You can have up to 6 months to watch them at your leisure. I'll be sending the link to that program, which is normally $2.99. We've got it on today for you for $1.99. In addition, we have the Master Series in Personal Financial Management program. This is an 8 video series that gives advisors 8 CE credits, which are approved by FP Canada. And this really is industry leading, an educational program that takes technical strategies of every aspect of financial planning and turns it into prospecting and sales strategies. So what we'd be looking at are engagement, building trust, tax planning, investment planning, risk management, retirement, so much good stuff. This one is normally $7.99. We are super generous today. It is down to $1.99. And to even sweeten the deal, if you want both of these virtual programs and you really want to take a deep dive into the prospecting and the technical, we'll offer that today for $350. So I will follow up with some information after the webinar, and have a look in your chat box and you'll see the links.
yeah, and certainly feel free to connect with, if we're not connected with you, look into our website, connect with me on LinkedIn and such. But before we do, we want to go to any questions that there might be. Elena, I would have one question before we open it up.
Mm-hmm.
What type of people are you seeing as your clients? What are their professions? What do they do? What's the primary area that you're working on today?
You know, we do anything border related. And by border related, I mean, we do income tax, franchise tax, and, you know, personal income tax, corporate income tax, estate tax. So it's a really wide scope of clients. So that's why we always say, you know, most of the work we do is very custom, right? Because, you know, there's a 5 large categories. So we have American expats in Canada. Most of them are either wealthy or very wealthy or ultra wealthy, so they have issues and they need our expertise. Yeah. Then we have athletes and entertainers. This category also includes movie writers and producers and directors. So we have a lot of relationship with LA, and therefore we know very well California state tax. So those people are mobile. They're you know, they can do work in multiple jurisdictions, and also there's a different treatment. Like, this is a very specific industry, how they're being paid. We have mobility clients. So mobility clients, these are the executives or senior management who goes across the border. They either go on secondment or it's a permanent transfer, and they may have equity benefits. Or, you know, they may come back with those equity benefits, and stock options, RSUs, SARs. So a lot of complexity. The treatments are not aligned. So we are assisting both taxpayers and companies in order to navigate the tax rules on both sides of the border. Then the 4th category are businesses. So we have Canadian businesses, that do business in the States, American businesses which are stretching to Canada, and they may be planning what would be the best format for them to operate, or they may be already operating and they want to make sure that they're properly reporting and paying tax. And the fifth category, I would say, it's the estates, cross-border estates and trusts. So this is by far the most complex area. That's when we have decedents in one country, executors in the other, or beneficiaries. We're working on the engagement right now. Again, cross-border estate, it has 122 various forms between two countries. So, you know, the entire office is actually working on that project just because it has so many moving parts. You know, we have a pretty good, you know, relationship with lawyers and advisors. So we understand that there's a lot of adjacent areas to tax. So we're certainly embracing those relationships because, you know, the idea is, the objective is to service the client, you know, accurately and efficiently. And, you know, we're looking out for those relationships with advisors as much as you may be looking with us as experts.
Beautiful. Great. Thank you. Tina, any questions? We've got a few.
One question that came through the chat. Elena, I know you talked about this at the beginning of your presentation, but maybe we can dig into it a bit more. The question is, suppose my mother owns a U.S. property valued at about $130,000. She bought it for $100,000. Should she give it to me or die with it?
Okay, thank you, Tina, for the question. That's a very common question we get. As I mentioned earlier in my presentation, U.S. estate is not fun. And, you know, if you, again, depending which state your mother holds the property, the estate and probate issues are different. So I would say off the bat, the simplest solution, my advice would be probably for your mother to sell that property during her lifetime, because if she sells, you know, considering that there's not much appreciation to the property, she will not be paying U.S. capital gain tax because the gain is too small. Okay, so it's about if it's the only income from the States for that year. So the first 42,000 of capital gain is excluded under or taxed at 0 rate in the States. Okay, and so you basically have to file a U.S. Tax return and report the disposition. You know, there may be FERPTA tax imposed on the disposition, maybe not, depending who the buyer is and how the buyer is planning to use the property. But, you know, if there is no FERPTA tax on sale, then filing the tax return and reporting the gain is pretty, you know, simple. And then you will have to report that gain on the Canadian return. And once it's done, there's no U.S. situs. If that's the only U.S. property mother has, there's no estate to worry about. There's no U.S. probate to worry about. So that's what I would probably direct for your mother to do. But I mean, that's purely from the tax perspective.
Excellent, thank you. And we don't have any more questions, so maybe Dan will let you sign off.
Yeah, we'll wrap that up, Elena. Thank you very much. That was fabulous.
My pleasure.
Reach out to Elena if you do have any questions, if you've got clients that need that type of expertise. You know, get used to working with this type of information to use to not just service your clients, but to also prospect to new potential clients that fit into your clientele. And so until the next time, and as Elena did mention, we've got the actual PowerPoint of all the slides for this presentation that we'll PDF put on our website and you'll be able to access as well. So once again, Elena, thank you very much. It's been great, and we'll see you all another time. Take care. Bye-bye.
Thank you for having me. Bye-bye now.
Thank you.
Bye-bye.
Bye-bye.